This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Closing in on the end of the first quarter, what's working and what's not, and which trends have emerged that could benefit investors in the second quarter.
Outdoor spin. CBS's Billboard unit goes public. Why this old media spinoff has investors excited.
Market Monitor, our guest tonight, has a list of companies that have undergone big restructurings, and now he says their shares are ready for takeoff. All of that and more tonight on Nightly Business Report for Friday, March 28th. Good evening, everybody. I'm Sue Herrera, filling in tonight for Susie Guerin.
And I'm Tyler Matheson. Welcome, everybody. It is not over yet, but the month of March and the first quarter of the year are just about history. And so far, Wall Street's performance has been about as welcome as this winter's weather, with the major averages swinging up and down like the temperatures, but ending pretty much flat for the quarter. And it's not just here. That same halting performance has been seen in markets all over the globe. So what trends outperformed in the first quarter of this year, which didn't, and what lies ahead for the second quarter kicking off on Tuesday? Bob Pisani takes a look from the New York Stock Exchange.
It will be a choppy end to a choppy quarter. Unlike last year's first quarter, when almost everything was up 10%, this quarter will produce some real winners and losers. It's what traders call a stock picker's market. Let's look overseas first. Many traders who were buying Japanese stocks like crazy last year suddenly got clobbered this quarter. Stocks had been rising there on a weak yen and on a Japanese stimulus program, but the effect of that boost has now faded. Now, China started off very weak, but has been rallying recently. The problem with China is that their growth appears to be slowing down. Now, here in the U.S., gold mining stocks, which were among the worst performers last year, were very big gainers, as were airline stocks, which rose on higher profits and on reduced capacity. But the most discussed change in the market came from new tech and social media stocks, high flyers. For example, Groupon, Twitter, Amazon, LinkedIn, and even Netflix, all of which started the year very strong, drooped in the second half of the quarter as traders became more concerned with valuations. Now, we'll start earnings season for the first quarter in just 2 weeks. The expectations are not very high because many companies, particularly retailers, cut their earnings forecast due to the brutally cold winter. But there's considerable hope that activity will pick up now that the weather is finally starting to improve. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And joining us now to talk more about the markets and his second quarter expectations is Russ Kestrich. He's Global Chief Investment Strategist with BlackRock. Russ, good to have you back. Welcome again.
Oh, thanks for having me.
All righty. I want to get to one of the risks that you're concerned about in the second quarter of this year, and that is geopolitical instability. And within just the past few minutes, we've gotten word that President Obama and Russia's President Putin have had a conversation where actually Mr. Putin called Mr. Obama trying to work out a, quote, diplomatic resolution to the crisis in Ukraine. What would a, quote, diplomatic resolution of this instability in that part of the world mean to the market, and what would happen if things heat up rather than cool down?
Well, I think right now the risks are to the downside in terms of things heating up. A solution from the market's perspective means that this gets taken off the table. This is not something investors have to worry about, either an escalation of violence or an escalation of sanctions that really materially impacts the economy. The risk is not so much that things are going to blow up or get out of control in Ukraine. The problem is more that there's very little bad news discounted into the market. You've got volatility well below the long-term average, and it means that if you do get an unpleasant shock, that's something investors are not prepared for.
What about if it does it green light the market, though, if they do reach some sort of diplomatic resolution?
Well, I'm not sure that's going to produce a rally because, again, I don't think the market's expecting a particularly bad scenario right now. Instead, I think really what you need to get a catalyst for a leg up in the market is less about the international situation, less about the Ukraine. It's closer to home. As we get into the first quarter earnings season, do we see positive guidance? Do we see an improvement in the economy? Do we see better earnings? That, to me, is the necessary ingredient, less so what's happening in the Ukraine.
So, Russ, one of the stories of this first quarter has been the sort of rotation away from what we've been calling the momentum stocks, which are stocks basically that go up because they were going up, and a move toward more value, I guess, in the market. Do you expect that trend to continue in the second quarter?
I think it will. And I think this is a really important point because, the fact that the market's been in a trading range the last few weeks and really the whole quarter obscures the fact there have been some pretty large rotations going on. We've seen a movement out of the glamour stocks, out of growth into value. We've more recently seen a move out of small cap into large and mega cap. They reflect the same underlying trend. In a world where most of the major asset classes are close to fair value, investors are looking for bargains. And I think what you're seeing now is a rotation into parts of the market where investors see some relative value. In my opinion, that's likely to continue.
All right. So do you go more for the large caps and leave the mid caps and the small caps behind this year?
I think that investors do want to have a modest tilt to the large and the mega cap names. A couple reasons for that, Sue. First of all, they are cheaper. They're much cheaper. But second of all, if you think what's likely to happen on the monetary side, if we do see a creep higher in rates, particularly real or inflation-adjusted rates, that is probably a bigger headwind for small and mid-cap names, which tend to experience more multiple compression when real rates rise than large and mega-cap names. So I think the larger companies are likely to be more resilient if we do see rates rise.
Russ, always great to see you. Thanks for being with us.
Thanks, Tyler.
Russ Koshrich is Global Chief Investment Strategist for BlackRock.
It was a volatile Friday to wrap up a volatile week on Wall Street. Stocks soared higher early in the session before ending the session with only modest gains. Good economic data helped, of course, with personal income and personal spending both rising 0.3% in February, despite all that cold and snowy weather at the start of the month. On Wall Street, the Dow was up as much as 150 points shortly after the open, ended 58 points higher, and higher for the week as well. The Nasdaq added 4, but ended its worst week in a year and a half after a sell-off in internet and biotech stocks. The S&P today adding 8, and it was pretty much flat for the week, Ty.
Sue, a solid debut for CBS Outdoor Americas. That's the billboard giant spun off from broadcaster CBS. It began trading for the first time today. Shares moved higher right out of the blocks, surging more than 5% for the session as a whole. Morgan Brennan now on why this so-called old media form of advertising is now attracting a lot of new money.
Ever wonder who's responsible for those billboards on the highway? They're called out-of-home media companies. They own and operate billboards, airport signs, subway and bus station posters, even those neon displays you see in Times Square. They're considered old media companies, and today, one of the industry's biggest debuted on the stock exchange. Called CBS Outdoor Americas, the new company was spun off by its namesake, CBS Corporation. The broadcast giant spinning off its outdoor advertising business to focus more heavily on content.
The idea of splitting off the outdoor division, it was a positive for the outdoor group, plus a positive for CBS, because it gives us more cash and gives us more ability to continue to expand in the content business.
But CBS Outdoor has amassed quite the display empire. The company counts 330,000 displays across the U.S. and another 26,200 in Canada and Latin America. And those numbers are likely to grow. For the industry, spending on outdoor ads grew more than 4% last year. That's why analysts say it's a good time for this so-called old media stock to go public.
The outdoor economy's picked up a little bit, and so you've got a positive move in the stock price. But CBS is not going to stay in the outdoor business. They're still an investor, but their core business remains entertainment.
So far, investors seem to agree. CBS Outdoor stock surging 5% in its first day of trading. A big difference between this tried and true business and the so-called new media companies that have been garnering most of the attention on Wall Street. Compare that to King Digital, the maker of popular mobile game Candy Crush Saga. When that company went public just earlier this week, it dropped 15% on its first day. But for the industry's recent growth, advertisers still only spend about 5% of their ad budgets outside. And with a growing popularity of platforms like mobile, it's only going to become more challenging to attract those ad dollars. For Nightly Business Report, I'm Morgan Brennan on the Sunset Strip in West Hollywood.
Two blue-chip Dow components are going to battle. Walmart is suing Visa for $5 billion. The world's largest retailer alleging the payments giant is charging unreasonably high fees on purchases that Walmart's shoppers make with their credit and debit cards. Mary Thompson has more.
It's an expensive charge. In a suit filed in Arkansas, Walmart claims Visa illegally inflated swipe fees on credit card payments from 2004 through 2012. Walmart is seeking $5 billion in damages.
I think they're trying to get attention.
The suit is the latest chapter in a long-running dispute between the nation's retailers and Visa and its rival MasterCard. For years, the retailers, including Walmart, who pays a lower negotiated rate, maintained the two firms violated antitrust rules by overcharging retailers. In its court filing, Walmart claims Visa has engaged in a conspiracy with some of the nation's largest banks to illegally fix the interchange fees and inflate the network fees that Walmart and other merchants pay on Visa charge card transactions. Walmart declined to comment on the suit, as did Visa, though it wasn't totally unexpected. Walmart is one of 35 big retailers that opted out of an earlier $5.7 billion settlement with Visa and MasterCard. The retailers saying the swipe fee settlement wasn't tough enough and wouldn't prevent Visa and MasterCard from increasing swipe fees in the future. Among those filing separate antitrust suits against Visa and MasterCard, Macy's, Target, Office Depot, and 15 others. Walmart declined to say if it plans to file a similar suit against MasterCard, but analyst David Darst, whose firm is seeking investment banking business from Visa, says Visa's retail investors are protected. Under Visa's share structure, any litigation costs above and beyond reserves Visa already set aside will be borne by the $22 billion worth of Class B shares held by banks like J.P. Morgan that used to own Visa.
The largest banks and the largest credit card issuing banks will be the ones that actually bear the cost via their investment in Visa.
Walmart taking a swipe at Visa, looking to cut a cost that's ultimately paid by the consumer. For Nightly Business Report, I'm Mary Thompson.
Coming up, airline stocks have been flying high, and there's one regional carrier that many are calling the new darling of Wall Street. See if you can guess which one. The government is demanding at least $1 billion from drug makers for delaying generics. The Federal Trade Commission is seeking at least that much from big pharmaceutical companies, which allegedly took steps to impede the sale of cheaper generic medicines after the patents on high-priced brand-name drugs had expired. The drug companies being sued include Solvay, owned by AbbVie, Actavis, previously Watson Pharmaceuticals, Paddock Labs, part of Perrigo Par Pharma, and Cephalon, owned by Teva.
Another blow to PIMCO, the world's largest bond fund, which is still reeling from corporate defections over allegations of a hostile work environment. PIMCO's total return fund may not be returning very much these days. The flagship portfolio is trailing 87% of its peers so far this year, that according to Morningstar.
Different story at the nation's big airlines, Sue. Among the companies that have been top performers so far this year, especially Alaska Airlines, with shares up 24% since December. And Alaska Air, which is breaking out of its niche of flying only in the western U.S., may be about to soar even higher. Phil LeBeau has more.
With the Eskimo on the tail, Alaska Airlines stands out on the tarmac, and increasingly among flyers looking for a new way to the western U.S.
I think they are efficient, friendly, and they do a pretty good job.
From my experience this time, I like them better from other airlines I've flown.
From its hub in Seattle, Alaska is rapidly expanding, adding flights to 5 new cities, including Baltimore and Tampa.
This latest move today is really just about strengthening our hub in Seattle and sort of playing to our strengths here.
Because it's smaller than other airlines, Alaska has been willing to try new ideas for customer service, like boarding passengers from the front and back of the plane. Next month, passengers will be able to print out bag tags at home, so they'll spend less time waiting to check luggage at the airport. Alaska's also testing an app telling you wait times at security before you get in line.
I have 4 choices literally right this moment at the Seattle airport. Which one is the fastest? Oh, the fastest one is the one down here. I am very happy to walk down there to get the faster line.
But as Alaska gets bigger, it's also facing stiffer competition. Delta is expanding in Seattle, and other carriers are adding flights along the Pacific coast.
Alaska is very much a West Coast airline, and while they have added flights from Seattle and a few other places to the East Coast, ultimately it ends up touching either in Seattle or Portland, and they've got to figure out what to do. They're really hemmed in.
Despite potential headwinds, Alaska is proof airlines have room to soar even higher. Phil LeBeau, Nightly Business Report, Seattle.
Blackberry posts a smaller than expected loss, and that's where we begin tonight's market focus. Cost-cutting helped the struggling smartphone maker's fourth quarter results, but sales still missed estimates. The company has lost a stunning $5.9 billion for its fiscal year, but the CEO says a turnaround is in sight.
We need to build up the capability both in engineering and marketing and as well as in the sales force. So, but we're going to be very moderate. Everything we talk about being able to be cash flow positive by the end of the year, fiscal year, and being profitable the next fiscal year in some quarters, it's still right on.
Nonetheless, shares fell 7% to $8.41. Finish Line's quarterly earnings rose 25% on stronger same-store sales. The athletic gear retailer said demand for basketball shoes helped make up for a slowdown in sales of running sneakers. Despite the increase, revenue came in short of estimates. Still, shares were up 2% to $27.05.
Massachusetts is blocking the sale of Zogenix's controversial but FDA-approved painkiller, Zohydro. The state declared a public health emergency that stems from the abuse of opioids. The drug maker criticized the move, saying it unfairly restricts access to an approved drug. Shares tumbled on the news, down almost 7% to $2.73. An upgrade lifted the shares of Cognizant Tech. Morgan Stanley upgraded its rating on the stock to overweight from equal weight. The firm's analyst says the company's growth potential may have been underestimated. Shares were up about 4.5% today to $46.69.
Our market monitor says individual stock selection is a much more significant factor in portfolio performance this year than it was in 2013, when virtually every stock in the S&P 500 and the Dow went up. He's Jordan Posner. He's Senior Portfolio Manager with Matrix Asset Advisors. Welcome, Jordan. Nice to have you here.
Nice to see you, Sue.
So what type of stocks do you find still have value? We talked earlier to Russ Kostrich, and he said they're favoring the larger cap stocks. Does that fit in with your portfolio selection?
Well, we're a large cap stock manager, so we're always looking for stocks within the large cap sector. What's interesting is that what we're finding most attractive are stocks in the financials, the industrials, and the energy sectors. And that's because we're expecting that the general economic activity in the U.S. and actually worldwide will improve throughout the year. And these three sectors should have pretty good participation in that recovery. And the stocks we think in those sectors are pretty cheap.
You know, Jordan, it's been a kind of choppy first quarter of the year, which ends on Monday. Is that the kind of performance, a little higher volatility than we'd been accustomed to, that you expect for the remainder of the year?
Well, we would expect that for the year, you'll probably see something in terms of total return, dividends plus appreciation, in the range of 8 to 10%, which is a kind of a normal historical range. But we do think that there'll be volatility throughout the year, and we would expect there to be some type of correction, perhaps as much of a 10% correction at some point during the course of the year, and that's typically generated by some kind of unforeseen macro event. We would prefer to use the dips down, the downward volatility, as an opportunity to buy stocks that we think are attractive and wouldn't necessarily chase rallies to increase in asset allocation.
Let's go through some of the stocks that you do find attractive at this point. In the healthcare sector, Hologic, why?
We're looking at companies that have the ability to improve their business internally, not just sell more widgets, as it were. Hologic has had some turnover. There's a new CEO, very well reputed. He's brought in some excellent operators. The businesses are real franchises. They're the leader in mammography for women. It's a terrific business, throws off a lot of cash. And the company is really working to restructure itself during the course of the year. We would expect that 2014 will be an ebb in earnings, and when we look into 15, the stock is trading at around 13 times, and we think that our estimate of the intrinsic value of the company is probably something close to 30.
Your second choice is Occidental Petroleum. It's about $94 right now. You see it getting to 121. How's it going to get there?
Well, we think that'll take maybe some time, probably over the course of a couple of years. But as the result of some management turmoil, actually a fight in the upper realms of management, the CEO, who's continued to be there, Mr. Chazen, has gone after a separation of the company, selling some assets, unlocking some of the value. And when you look at the sum of the value of the parts, that's closer to $120 a share. You'll start to see actions taking place in the second half of 14 and into 15, and which will unlock that value and make it become much more visible.
And let's finish up with Devon Energy, which, you know, the stock has had a little bit of tough sledding, but you think that management is making some rather aggressive moves to right that ship and make some changes.
Absolutely. The company has historically been perceived as very oriented towards natural gas, which has been a difficult area. They've been reinvesting very heavily, getting rid of assets and reinvesting in more oily assets, as it were. These assets have much higher valuations, generate more cash, and they've done a very good job in terms of refreshing and upgrading the asset base, and that really has not been reflected in the stock.
All right. Of the stocks that we mentioned, do you have any disclosures to tell us?
We own all three of these stocks for our clients, and my family and I own them ourselves.
All right. Jordan, thank you so much. Have a great weekend. Good to see you again.
Pleasure.
Jordan Posner. All right, coming up when we come back, millennials and money. What makes this generation of investors so different from previous ones? General Motors is expanding its ignition switch recall to include an additional 824,000 cars. That is on top of the already recalled 1.6 million vehicles. The recall now includes all model years of the Chevy Cobalt, the Chevy HHR, the Pontiac G5, the Pontiac Solstice, and the Saturn, Ion, and Sky. Ty?
And Sue, a big win for Tesla, the electric car maker, striking a deal with New York Governor Andrew Cuomo that will let Tesla keep its existing stores in the state. CEO Elon Musk has been battling a few other states that have challenged its direct-to-consumer Tesla sales model. Separately, federal safety regulators ended an investigation into its Model S sedan following some recent car fires caused by road debris puncturing the lithium battery. The company says it'll add an additional metal shield to the undercarriages of all new and previously purchased Model S cars to stop foreign objects from damaging those batteries.
And finally this evening, a peek into what the future of Wall Street might look like as some young millennial investors met at the University of Dayton's RISE conference discussing their investment strategies. And Dominic Chu was there.
Once a year, some of the brightest young investors in the country and around the world gather here for the University of Dayton's Student Investing Conference. It's known as RISE, Redefining Investment Strategy Education.
You need to be trustworthy, ethical, and responsible.
It's here that the millennial generation comes to exchange ideas and meet some of the industry's elite personalities.
I started with the Federal Reserve right out of college. And 3 decades later, I've had a fascinating and rewarding career with the Federal Reserve.
So, what attracts these titans of Wall Street? They know these students have their fingers on the pulse of the market.
I love their energy. I love getting some great ideas from them. And honestly, I'm also looking at potentially hiring a few down the road.
What makes the next generation of investors different than the previous one? Students like Nathan Haig from the University of Dayton are taking a much different approach to investing than his parents or grandparents did.
I think the older generation typically is invested a lot more in, the blue chip single stocks, whereas somebody like me, I'm a little more tactical. I like kind of the shorter time frame, maybe 3 to 12 months, and I typically do this through ETFs and mutual funds.
Others are focused on some more established and traditional old world investments, like in the energy sector. Anya Mesa from New Jersey City University is focused on picking individual stocks.
We have HP, which is Helmerich and Payne. We covered that for about a little bit over a year right now. We've received about 116 return on our investment. It's definitely amazing.
Biotech, for one reason, is usually if you play it right, the risk can match the reward.
I love cloud storage. It's a progressive industry that's something that everyone needs, and it's growing revenues.
You know, I really like social media just because the massive potential it has, and everybody's on it. There's always new acquisitions that companies are taking, and it's a growing industry, and I think we should take advantage of that.
Many students have a great track record, one that even the pros would be envious of. But they're trying not to rub their success in too much. As they know, mastering the markets from the market masters is just one step taking them towards their dream jobs. Stay tuned because these folks are the future of Wall Street. For Nightly Business Report, I'm Dominic Chu.
Looks like they have some very bright futures, too. Some of those picks were great.
Meet your new boss.
I know, no kidding.
We'll be working for them in a few years.
Sure will, hopefully.
Yeah.
All right.
Yeah, hopefully.
That does it for Nightly Business Report for tonight. I'm Sue Herrera, filling in for Susie. Thanks for watching.
And I'm Tyler Mathisen. Thanks for me as well. Have a great weekend, everybody. We'll hope to see you back here Monday night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Tyler Mathisen with a Nightly Business Report news brief. A volatile day to wrap up a volatile week on Wall Street. All the major averages end the day higher, getting a boost from a rise in personal incomes and personal spending last month. The Dow up 58, NASDAQ higher by 4, but sharply lower for the week. The S&P 500 was up 8. Shares of CBS Outdoor Americas, that's the billboard giant spun off from the broadcaster CBS, surged more than 5% in its debut today. More trouble for General Motors, which ordered dealers to stop selling certain late model versions of the Chevy Cruze, but it won't say why. The Federal Trade Commission is suing big drug makers for more than $1 billion for delaying the sale of cheaper generic medicines after the patents expire on branded drugs. And tune in to Nightly Business Report right here on your public television station.